Hello folks, this is Sam Hisside speaking, and today I will talk to you about the accounting ratios. We will see together what are the most common types of the accounting ratios, how to measure them, and more importantly and more notably, how to translate and use them. Stay tuned. Accounting or financial ratios are a group of metrics used to measure the efficiency and profitability of a company using its financial reports. Ratios are expressing the relationship between one accounting data or piece of information to another. An accounting ratio compares two items in a company's financial statements. These ratios can be used to evaluate a company's performance and provide information about how good or bad they did over the last quarter and financial year. Analyzing accounting ratios is an important step in determining the financial health of a company. It can often decide the areas that are bringing the profitability of a company which need improvement. The efficiency of new management plans, new products, and changes in operational procedures can be determined by analyzing accounting ratios. Accounting ratios also work as an important tool in a company-to-company comparison within an industry, or so-called benchmarking. A thorough accounting analysis can be a complex task, but calculating accounting ratios is a simple process of dividing two line items found on a financial statement that provide a quick form of clear analysis to business owner and investor. These accounting ratios and formulas can help you ensure your business financial health is in order. Accounting ratios offer quick ways to evaluate the business financial condition. According to accounting scholars, ratios are the most frequently used accounting formulas in regards to business analysis. Analyzing your finance with these ratios helps you identify trends and other data that inform important business decisions. Here are the most common types of ratios that you can use within your company: liquidity ratios, profitability ratios, leverage ratios, turnover ratios, market value ratios. While it may not be possible to constantly analyze all of these ratios at a given time, it is crucial to pick a few that may help you identify what's happening within your company. The first set of ratios are liquidity ratios. These ratios are used to calculate how capable a company is to pay its debts by measuring current liabilities and current assets or liquid assets. Here are some common liquidity ratios. Current ratio equals current assets divided by current liabilities. The purpose of this ratio is to measure if your company can currently pay off short-term debts by liquidating your assets. Quick ratio equals quick assets divided by current liabilities. This ratio is similar to the current ratio above, except that to measure quick assets you only consider your accounts receivable plus cash plus marketable securities or bonds, not all current assets. Cash ratio equals cash divided by current liabilities. This ratio tells you how capable your business is of covering its debts using only cash. No other current assets are considered in this ratio. The second set of ratios are profitability ratios. Accountants use these ratios to measure a business earnings versus its expenses or costs. Here are some common profitability ratios. Return on assets equals net income divided by average total assets. The return on assets ratio indicates how much profit businesses make compared to their assets or out of their assets. Net profit ratio equals net profit divided by sales revenues. The net profit ratio is an easy way to tell how much of your net income comes from sales, or what is the percentage of your net profit from sales. Gross profit ratio, which equals gross profit divided by sales or revenues. The gross profit ratio is an easy way to tell how much of your gross profit comes from sales, or what is the percentage of your gross profit from sales. The third set of ratios are the turnover ratios. Turnover ratios are used to measure your company's income against its assets. There are many different types of turnover ratios. Here are some of common turnover ratios. Inventory turnover ratio, which equals cost of goods sold divided by average inventories. The inventory turnover shows how much inventory you have sold in a year or other specified period. Assets turnover ratio, which equals sales divided by average total assets. This ratio is a good indicator of how good your company is at using your assets to produce or generate revenues. Accounts receivable turnover ratio, which equals sales divided by average accounts receivable. You can use this ratio to evaluate how quickly your company is able to collect funds from its customers. Accounts payable turnover ratio, which equals total supplier purchase divided by average accounts receivable. This ratio measures the speed at which a company pays off its suppliers or how good they are at negotiating some credit terms or credit limit agreements between them and their suppliers. Well, that brought us to the end of that video. I'm Sami Al Sayed. I hope you've enjoyed it and see you soon.